Well, hello, Matt here. Thank you for watching this video on the net present value. What we're going to do over the course of the next several minutes is I'm going to walk you through the net present value formula. And so we're going to talk about really what net present value is, what the purpose and function of it is, and then we're actually going to go through a problem, if you will, and I'm going to show you step by step actually how to calculate net present value. And it really isn't that difficult, although it can be depending upon the complexity of the capital budgeting project that you're working on. So really to start, the net present value, which is commonly abbreviated simply as NPV, is simply a capital budgeting tool. And NPV comes up a great deal in corporate finance, and so if you've taken a class in corporate finance, one of the things that generally is covered is net present value. And the whole purpose of NPV is to help a firm assess the level of importance certain capital budgeting projects have. So capital budgeting or capital expenditures usually are high dollar value items, typically referred to as CapEx, and those generally include purchasing large pieces of equipment, things that are very expensive, property, plants, things that are going to have a great deal of value, generally fixed assets. They're long-term and they are generally very expensive. And so what companies try to assess is, I'm going to spend potentially tens of hundreds, if not millions of dollars on this item, whatever it is. We want to have some reasonable assurance that the future cash flow, which is the money generated from the project, is going to be enough to pay off that project within a reasonable amount of time. And it's up to the business to determine what a reasonable amount of time is. And also the helpful thing too is that many businesses have probably half a dozen to a dozen different projects or opportunities at their disposal, things they're seriously considering. And a capital budgeting tool like NPV helps a firm evaluate those different options to see what's going to be the best one for them. And so they can weigh them, essentially utilizing NPV to determine which one has the most likelihood of success given all of the alternatives. So that's kind of the purpose, a little bit of the backstory, why we use NPV. So let's walk you through kind of how to calculate NPV. So the first thing is, let's get a couple of examples going here. So first thing, just for sake of example, let's say that we are going to purchase a business. We'll keep things fairly simplistic just so you kind of understand the process. And let's say we're going to purchase a business for $10,000. And we want to determine if we're going to invest $10,000 today, depending upon how much money we feel is going to be generated by this business, is it going to essentially kind of work itself out? Is it going to kind of pan out? And so we want to see if we can pay this off within 3 years, if the money generated is going to make sense in 3 years. And so what we're going to do is we're going to draw a timeline. And we're going to draw some hash marks for each year. And I'm going to give you just some projections in terms of cash flow. And so let's say that we believe that in year one, which is going to be abbreviated up here, we believe we can generate $3,000 in cash flow. So this is not in sales, this is actual cash flow generated from the company, so after all expenses and taxes have been paid. In year two, we believe we can generate $4,000 in cash flow. And then in year three, we believe that we can generate $5,000 in cash flow. So if you were to look at this very simplistically, the first thing you would think of right off the bat is, well, I'm generating $12,000 a year, or $12,000 in 3 years, rather. So I have $3,000 in year one, right? $4,000 in year two, and then $5,000 in year three. Add those up together and you get $12,000. $12,000 is more than 10, so I'm obviously making out ahead. There, I'm done. I don't have to do anything else. But the problem is we're not considering the time value of money. And if you watch the earlier video that I recorded on the time value of money, we know that money changes in value over time. It decreases. So if I had $10 today, that $10 is going to be worth more than that same amount of money, that $10 in a week, a month, or a year because of inflation. Money depreciates obviously in value. What I can do with it essentially is less. My purchasing power erodes, and then I also suffer from opportunity costs. If I don't have it in my possession, I essentially give up everything that I can do with it. And so because of the time value of money, because this $3,000 here a year from now is not the same thing as $3,000 today, because I can't do anything with it, and inflation is going to erode the purchasing power of that $3,000, I can't necessarily compare this $10,000 with all of these different values because they're from different time periods. And so what I have to do is I have to engage in a process known as discounting. And discounting means we're going to take each of these values and we're going to discount it back to today's dollars. So essentially we're going to change the value and put it into the worth of today so that we can compare essentially what we're getting in future cash flow to what it would be worth if we had it presently in our possession. So the way that we do that is we utilize a formula which is called the present value formula, and that is PV equals FV divided by 1 plus I to the nth power. And so what these mean, let me define these here real quick, is the PV is what we call the present value. This is the value, the numerical value of the money today. So this is what the money is worth essentially today. FV stands for future value. This is the money at a future point in time. So this is the value of that particular money, the kind of numerical figure at some time in the future. I stands for an interest rate. When we're calculating NPV, we generally assume I to be a relatively risk-free return. It's essentially what we could do with it. If we had this money presently in our possession, what could we do? What's a general safe rate of return, if you will, that we could gain from it? So we discount it by that amount because arguably if we had the money in our possession, we could earn, let's say, that amount on it. And then N is the number of periods. This can be expressed in months, years, weeks. It could be on a semi-annual basis. You can change the actual unit of the periods. We're going to use years simply because it is a little more simplistic. It's not as complex to figure out, but you can generally do this on a month-to-month basis. You can do it on any other kind of system you wish to do so. So just know that for future purposes. So the first thing we need to do is we need to solve each of these, right? We have to discount each of these future cash flows into present value so we know what we're doing here. So let's go ahead and do that. The reason I went with 3 years is because if we're doing this by hand, this is going to take a little bit of time. It can be somewhat tedious. The process is very simple. It just can be a little difficult. You can use a financial calculator for this, which makes it a lot easier. And so if you're going to be doing this on a regular basis, you'll probably figure out how to do that. So let's go ahead and do it determine the present value for year one. So first, we're trying to figure out what PV is, right? And so we know that the future value is $3,000, right? Because that's how much future cash flow we have in year one. That's the future value of that particular investment or sum of money, if you will. And we have 1 plus the interest rate. So let's just go ahead and assume, just for sake of simplicity, that we believe we can earn 5%. So that's what we're going to discount this at. And this is in year one right here. So we're only discounting it 1 year. And so we're going to do it to the first power. So 3,000 divided by 1 plus 0.05 actually comes out to $2,857 and rounding 14 cents. And so $3,000 discounted at 5% for 1 year is worth $2,857.14. And so what we're going to do is we're going to go ahead and write that figure right over here. And we're going to do the exact same thing and calculate the present value for year 2. So for year 2, let me just put first year. And here we'll do second year. And so we have a future value of $4,000 in year 2. Same thing, we're dividing by 1 plus 0.05, and this time though it's going to be the second power. And so 1 plus 0.05 to the second power actually comes out to 1.1025. And we're going to divide that into our $4,000, which is our future value, which gets us a numerical value of $3,628 and, once rounding, 12 cents. And so once again, let's go ahead and include this amount over here. And so once again, $4,000 discounted at 5% for after 2 years, discounted for 2 years, is worth $3,628.12. So last one, third year, we have a $5,000 future value. We're going to divide by 1 plus 0.05, this time to the third power. So 1.05 to the third power comes out to 1.1576250. When you're dividing by these, it's really important that you don't round this initial figure, because if you do, that's really going to change the present value that you get. So you can round the end figure, that's fine, meaning the end result, like this number here, but try not to round something that you're going to divide into, because that's going to drastically change the end result. All right, so 5,000 divided by our 1 plus 0.05 to the third power ends up coming out to, let's see, $4,319.19. So you can see that's drastically different than this $5,000 that we have up here, because we're discounting it for 3 years at 5%. So that $5,000 3 years from now, obviously we don't have access to that. That's going to be the same dollar amount, but what we can do with it in 3 years is obviously much less. So in today's value, that is $4,319.19. And so what we do now is we compare our investment of $10,000 to the future cash flow, which is discounted into today's dollars, and see what the difference is. And so if you add all of these up, these actually come out to $10,804.45. And so what you need to look at here is this figure, this 10,805 figure, is greater than this 10,000 figure by $804.45. And so the way that the NPV works, we're going to go ahead and move over here, is that a figure that is greater than 0, we usually accept the proposal. And so that means that the present value of all the future cash flows is greater than the actual investment, in which case it's a good investment by NPV terms. Now, by how much greater, it depends upon, obviously, the numbers that you have. So if you're like $1 over, right, if your NPV literally is $1, technically you accept the proposal, but it's really not that strong. And then so you're going to compare that to all of the other options that you have. It may not be as optimal as some of the others. Now, if the NPV is less than 0, then we reject the proposal. And once again, that means that the future value or the present value of all the future cash flows isn't enough to substantiate the investment. We probably have other projects that are going to be more well suited for what we're trying to accomplish. Once again, though, if it is below the 0 by $1, right? So technically it's pretty close. So that's really a judgment call. That depends upon a number of different factors. Now here we're just evaluating future cash flow. So this figure is going to depend upon how accurate you would calculate or project future cash flows. If you're overly optimistic, you're probably going to get a wrong NPV. If you're very, very conservative, maybe it'll throw your NPV off a little bit. So you have to weigh that as well. In this case, our NPV is $804.45. Since that is greater than 0, we would technically accept the proposal or project, in which case it's a good idea. Now, there are a number of other capital budgeting tools that you can use. NPV is simply just one of them. So you can utilize a number of different alternatives. You can utilize the payback period and a number of others to help get a more accurate picture over whether this is a strong idea or not, whether this is something that you should pursue. So you never should rely solely on one. But as you can see here, it's fairly simplistic. It's not very difficult to actually calculate. The important things is maintaining a good sense of organization, right? You're dealing with a lot of different numbers if you're drawing these things out by hand. And so that makes it very difficult. If you get one number mixed up, you're going to throw everything off. So that's what I would say is certainly be organized. If you're going to utilize these for some long projects, right? This is only 3 years. It's not uncommon for capital budgeting projects to have 30 years in terms of a lifespan. That would be very tedious to do this for 30 years. So you probably want to use a financial calculator for that. It would make things much easier. You can probably solve it in a matter of minutes and would save you a lot of time. But that's generally how NPV works and how to do the actual calculation. So hopefully that was helpful. If you have any questions, comments, feel free and leave a comment, and I'll try and get back to you as soon as I can. Thanks for watching.